We expect that the Reserve Bank will cut the cash rate by 25 basis points, that is quarter of a percentage point, tomorrow. And we're also expecting 2 further cuts over the course of the rest of the year.
When do you expect to see those cuts?
At the moment, we've penciled in August and November. We think the Reserve Bank's still concerned about lingering inflation pressures, so they won't be in a hurry, even though sort of the world economic situation is looking worse.
What do you make of the divergent views right now of the economics teams of the major banks, and why the big banks are forecasting a different easing cycle? I think the forecasts vary between 3 and 5 cuts in the next 12 months.
I think part of it rests on people's different reads of the risks around the global economy, but I think it also reflects different interpretations about how the RBA itself is seeing the world. I mean, we've had, a good 6 or 9 months where the Reserve Bank has been very hawkish on inflation risks. It's trying to fine-tune the inflation result to show a sustained forecast at 2.5%. So one of the reasons why they were so hawkish in February was their forecast said trimmed mean inflation is going to be stuck at 2.7 instead of 2.5. And their interpretation on the statement on the conduct of monetary policy says you should be aiming for the midpoint of the target range, which is 2.5, obviously in a 2 to 3% target range. So I think, not everybody is sort of keying into those particular nuances of how the RBA is seeing the world, or maybe they're sort of putting more trust in the idea that the RBA will change its mind. I mean, the RBA is well out of consensus in terms of its February forecasts about consumption growth. So at Westpac Economics, we're expecting household consumption to increase about 1.5% over calendar 2025. And that's the sort of the median of all the market forecasters. The February forecast from the RBA was 2.6. They're well out of consensus. They're very bullish about the tendency for people to pick up their spending. But that's not what we're seeing in our own Westpac DataX data. It's not what we're seeing in the ABS data.
Are there real risks for the Reserve Bank in getting this easing cycle wrong if they wait too long to cut, or alternatively, if they cut too quickly?
Well, I think in terms of the risk of cutting too quickly, I don't see that as how they'll play out, because I don't see them as panicking. Markets did go through a bit of a bungee jump in April after the tariffs were announced by the US Trump administration. People have sort of had a bit of an intake of breath and a realisation that those tariffs were never going to go through as initially announced, because they are an act of self-harm for the US. And I think the RBA understood that, so it's not going to panic. There is, I guess, a risk that they might be too reluctant to cut rates, and that they'll end up keeping policy still restrictive for too long. We've got to remember that monetary policy does operate with a lag, and so the decision they make tomorrow is going to have its peak effect on inflation next year. So working on the assumption that policy is still restrictive, and that's what we believe, that's what the RBA has said it believes, there is a risk that they're putting downward pressure on the economy and inflation at a time when it's no longer needed. But our best estimate is they're not putting a whole lot of restrictive pressure on the economy. They'll be pointing to the fact that, amazingly, the labour market has held up really well. We've seen employment growth do well. Unemployment is still at 4.1%. I mean, the last time we had a sustained period with unemployment this low, I was in preschool. So it's an incredible achievement for that to happen. But they're seeing that as the labour market still being tight. If it turns out that that unravels faster than they think, we could go through a period where inflation goes down to the bottom of the band or even below. I don't think they'll be too sorry if it goes down into the low twos. I think they'll have more cause to worry if unemployment really starts to ratchet up and inflation goes down below 2%.
Now, in the past, the Reserve Bank has expressed concern about rate cuts fueling house price rises. How important are rate cuts to increasing business investment and also productivity?
Well, starting with house prices first, there's a bit of a tug of war going on in the housing market at the moment. yes, lower interest rates will boost demand for housing, and we will see that putting some upward pressure on house prices. But that's in the context, firstly, of a housing market that already has affordability constraints. And secondly, population growth is slowing. We had that big surge in population in 2023 after the borders reopened. That is now unwinding. And in fact, it's actually unwinding a bit more sharply than both we and the Reserve Bank had been forecasting. Both of us thought that population growth over 2024 would be 2%. And then we got the September quarter data, which is the latest data that's available, and it was already at 1.8. So that population pressure on housing, both rents and prices, is actually unwinding and pulling, working in the opposite direction to whatever interest rates might do on prices. In terms of investment, there's not really a direct link. It's very hard to find a statistical relationship between what the central bank does with monetary policy, with interest rates, and what businesses do. The things that make businesses want to invest more is solidly growing domestic demand. So, we really need to see consumption growth pick up from the very low rates that it currently is, and then businesses will react to that. It's a more reactive process rather than something that directly keys off interest rates themselves.
The productivity.
And then in terms of productivity, and I think in Australia we have this belief that productivity is something the government or maybe the Reserve Bank does to us. And our view has long been that, firstly, productivity growth in the market sector, so outside of the care economy, is actually doing okay in Australia at the moment. There's no real sort of slowing down in trend. It's just that we've had this big expansion in the care economy and coal production's fallen, and that's reduced productivity, because all productivity is total output divided by the number of hours worked. It's just stuff divided by time. So I think there's not a straight line between what the RBA does and what happens to productivity. Where we might see a linkage is if the RBA clamps down too much on demand and on labour costs by keeping inflation low, then why would if labour is cheap, why would you invest in labour-saving devices that boost productivity? So I think it's a much more indirect relationship, and it's really about, if you end up with an economy that's weak, that's not really an environment for people to invest and innovate and boost productivity.
Finally, on a different topic, the Productivity Commission has opened consultation on the 15 areas it's identified for reform. Where would you begin?
Well, everyone thinks that people should start with tax, and that's not really where I would start. I think the tax system isn't the driver of people deciding to make their business processes more efficient. If it's worth doing, it's worth doing regardless of the tax rate. I think, one area of reform that we could usefully pursue is actually stop waiting for the government to do things to boost productivity, and to start taking responsibility for our own efficiency, for the way we use resources in our activities, and for the business processes and innovation that we adopt. And I think all of us need to stop waiting for a government policy to somehow make us more productive. Where the government can at least not be in the way is to be smarter about the way it regulates. There are always things that we will want governments to do to get the outcomes, the social outcomes that we desire, but you can do that in smarter ways versus more cumbersome ways. You can make, and that's just the hard graft of making sure that approvals to build things don't take months and years, and you don't have to spend years and years demonstrating the environmental impact. That whether getting to yes needs to be quicker, and people need more clarity over whether what they're doing is in fact within the regulations, instead of hoping that you don't fall foul later on. People need more clarity about when you are inside the line, as opposed to, we're not going to tell you if you're inside the line, but if you're outside the line, we'll tell you and fine you. They're the sort of things that really will make a difference for a lot of firms, but a lot of it's just that hard work of making sure that you've designed your processes and your regulations and your governance in the most efficient way. It's less glamorous than changing the tax system, but in my view, it would be more effective.
Luci Ellis, great to speak to you again. Thank you.
You're very welcome, Kirsten. Thank you very much.